all issues finance. So I just want to welcome everyone who's joining us. If you are streaming through Sauma HD radios, or you want to stream through Sauma HD radios, is www.sauma, SAUMA, hdradios.co.za, and also on our Facebook page, In His Grace and Mercy, and YouTube page, also In His Grace and Mercy, and on Instagram. Without any waste of time, let me just open with a word of prayer. Then we can kickstart. Lord, we thank you for today. We thank you for any other day, Mudumaka, where you've been with us, even as we sit to enlighten each other and learn. May you give us wisdom. May you give us enlightenment. May you give us discernment. And may we be able to action whatever advice we are given, Lord. We thank you. We honor you in Jesus' name. Amen. Thank you very much. You are not a stranger to In His Grace and Mercy. We did invite you before, and we are glad that when we invited you again, you were willing to come and give us education. We are in the tax season, and many people, this is the time where they realize, there's a lot in their finances, either that is not going well or where they need to fix. So I don't want to preempt what you are going to talk to us about, but I know you are going to cover an array of topics around financial planning, personal financial planning. So just go ahead, introduce yourself, and then go straight into what you want to tell us, and then I'll ask questions as we go along.
Okay, so thank you, Fina, for inviting me. I appreciate the opportunity to speak to everybody who's online right now. So my name is Curtis. I think I was here like 5 years ago. Was it 5 years ago?
Is
Must have
that
been
five
5 years
years
ago.
already? Oh.
Yeah, yeah. Time flies. Yeah, it's 5 years. And at the time, I had started the financial. I'd been 3 years in, so now I'm getting into 8 years. Well, I'm moving towards 8 years now, doing this. So I throughout the years, I've acquired a lot of knowledge on issues relating to how to grow your wealth, how to make sure you have a stable financial well-being, and also retirement as well, to ensure that you're set and prepared for retirement. So now that you started with the tax season, which is the introduction, let me start with obviously one of the things that are relating to tax.
Yeah.
So what happened is that the government has been trying to motivate people to save for their retirement. And what they did was they legislated that anyone who saves for retirement is going to get rewarded by SARS through tax returns. So the people that are filing for tax now, one of the things you have to submit is your retirement annuity certificate. And that you get from the provider that you're saving with. It could be Discovery, Old Mutual, Liberty. It just depends on where your retirement savings are going to. And then SARS would take that into consideration, and then they'll run a calculation. And based on the amount that you're saving, they will reward you by giving you more tax returns compared to someone who's earning the same amount as you, but is not saving. Now, the
Okay.
reason that was done, like I mentioned, is to motivate people to save. But outside of that, what tends to happen is the more money someone makes, it tends to happen that the higher their expenses, right? So then when you reach retirement, you might not have enough saved. And then this becomes a problem because then now you are not earning an income anymore. So
Yeah.
in order for the government to hedge against that, they said, look, let's reward financially people that are saving. And then let's punish those that are not saving, because then they're going to be a burden to us, right? So the more money you're making and the more comfortable you are in your life on your day-to-day job, the more critical it is for you to actually have substantial savings for retirement, because
Okay.
what's going to happen, and this is what I always experience, and this is the hardest part of my job, right? What
Mm,
happens is, when you reach 65, you're out of the workplace, right? So
mm,
whatever you have been earning, just consider that gone, because now you're not working anymore. Now you have to live on maybe the investments that you saved, or this other business that you have outside corporate, right?
yeah.
So now a lot of people then experience that shock wave that comes as soon as they reach retirement, because the following month the paycheck is not coming in anymore. So now the
Mm,
question is, what do you have saved? What do you have in your bank account? What do you have as assets? And what do you have in your retirement annuity? And then, if you're fortunate enough to have a business that's running, which most people don't, then at least you can also continuously earn some income from that, right?
yeah.
So I always have a difficult time when now I sit down with someone who's maybe 2 3 years away from retirement, and then they only have a few rand saved, and then now we're trying to figure out what to do, right? In
Mm,
most cases, the person has and will become a burden to the government. You
yeah.
understand?
So
So,
ideally, when is it the right time then to start having a saving, a retirement saving? As
retirement
soon as I
saving,
start working, or can I be
yes.
comfortable for the first 10 years and then start saving?
So how the retirement savings work is that they have what they call the compounding power,
Mm,
right? So what compounding power is the more money that you have invested, the faster the money grows, right? So the sooner you start, the better, right? So let's say someone who starts at like 25 is gonna have a substantial head start compared to someone who's starting at 30, 35, or 40,
mm,
right? Why? Because when you start at 25, the compounding power is working in your favor. So by the
yeah.
time you get to 30, the money that you have in there is growing at a much faster rate compared to someone who's just starting, right?
Mm-hmm.
Now, if you start late, the only way to catch up is now to save more, right? And sometimes
Mm,
that's very difficult, because you would have adjusted your lifestyle based on how much you earn, like what a lot of people do, right? And then now you have more money at an older age, you're earning more, but you have more expenses, you see?
mm,
And then that
mm,
becomes the problem. So now sometimes I'll have to sit down with some of my clients and say, look, you need to cut down on your lifestyle, because we are falling behind on our
yeah.
retirement savings, right? Now, on the more money you make, the more you should have on in your retirement savings account, right?
Yeah.
Now, yeah. Now, if that's not the case, what's going to happen is, if you're earning a lot of money and then you have little retirement savings, you're going to experience a significant hit in your lifestyle compared to someone who's making way less than you, because they're already living a much lower lifestyle than you,
Mm,
right? And
mm,
sometimes the you might need to trade some of the luxurious assets that you have, just so that you
yeah.
can be able to survive the wave, right?
Mm,
Now what happens is, SARS has, whenever they give you your tax returns, like you say people are filing now, they actually do it as a calculation, right? So what
okay.
they do is, they take your income, how much you're earning, and then they see how much you're contributing to SARS every
Mm,
single month through tax, right? It's all on your
mm-hmm.
pay slip. And then they they punish you more if you're earning more, because then you're losing more from the tax returns that would pay you. So the more
Mm,
money you're paying in tax, the higher the tax returns you can get, right? And
mm,
those are capped at 350,000 a year. So there
okay.
are people that can get up to 350,000 in tax returns every single year. And there are people that
Mm,
are getting that amount of money from SARS every year when they file for tax returns. You see? So it just depends on how much you're saving. So the more you save, the more SARS rewards you through tax returns. And then now, if you're not saving at all, it doesn't matter if you contributed 300,000 in a year to SARS. They still say, look, we have run a calculation, we've realized that you're not preparing for your retirement, you're going to be a burden to us, the government.
Mm,
So we're not going to give you anything from that 300,000 that you paid to us in the year.
mm,
See, so that's pretty much how it works. And then obviously there are other things like medical aid and those other smaller things that they put in to when you're filing for your tax returns.
yeah,
Obviously those are done by your tax practitioner. But the main thing that that they look at is your retirement savings when you're filing for the tax returns. And you can actually pay SARS a lot of money in a year, 200, 300,000, and then you can file and you can be owing SARS money,
yeah,
right? It depends
yeah,
on on what you were doing that financial year. So it's of great importance that outside the tax returns that you're saving for your retirement, and then you need to have a financial consultant who can calculate for you based on your earnings how much you should have for retirement, so that you don't experience a significant drop in your lifestyle.
yeah.
You see,
Before
now.
before we move,
Mhm.
just so that we bring everyone on board. So if I work for government and there's a pension fund, do I still need an RA,
So the
retirement
pension
annuity?
Yeah, so the pension fund is mandatory, right? So that one doesn't really give you much points from SARS, right? If
Okay.
it does give you at all, because that one is a mandatory saving. Now, part of the reason why they don't really consider it as a saving is because what tends to happen is when a lot of people change jobs, right? They can cash out on some of that money, right?
Yeah.
And
Yeah.
then if you change jobs, then you take your pension, you buy your child a car, you buy another property, you buy this, you pay off your debts, right? You can get to retirement age, then you don't actually have any money,
Mm.
right? So I know
Okay.
people who have been working for over 20 years and they have switched jobs like 3 times, right? And then
Mm.
when they switched, they cashed out on their pensions. And then when they did that, tends to happen, you end up not having any money saved at retirement age.
Okay.
So that's why the retirement annuity is of importance, because then your money is locked in. You're not allowed to cash it
Okay.
out, right? They now have this two-part system that they put in place, but you're not allowed to cash out that money because it's supposed to be money that you're going to use at retirement age.
At
You
retirement.
see?
Okay.
Yeah,
Okay.
yeah,
So you are saying to people, even if there's a pension fund deducted from your salary, it's not it's not a retirement annuity plan. You still
yeah.
require to plan, and that's where above what is deducted mandatory, as you said, you have an amount that you've set aside that comes of your money, and this comes after your taxes and everything has been paid, right? So it comes
Yes.
out of what goes into your pocket.
Yes, and then your financial advisor will sit down with you and say, "Look, what do you wanna? Which company do you wanna work with?" Like for me, I do Discovery and Liberty, so you can be like,
Mm,
"I want to save with Discovery." Then I'll open a retirement annuity with you with Discovery, right? So
mhm.
then, after all the deductions and the money is in your bank account, then that is when now Discovery would debit your bank account to put into your retirement savings. Now that is connected to your tax number. So when they make that debit, SARS is already notified that you're saving 3,000, four
Mm,
thousand, 500 rand a month, whatever amount that you're saving. And then SARS will run a calculation for those 12 months that you saved. And they'll say, okay, you were saving 1,000 rand every month for the past 12 months. Now, this is how much we're going to pay you back at tax returns based on how much you're contributing towards SARS. You
yeah.
see? Yeah,
Mm,
so that's pretty much how it works. Now you can, even when they're taking money, even if you are saving on your pension, that's why you can still owe SARS when you file for tax returns, regardless of
mm,
how much you're saving on your pension, because that has little to no effect when it comes to your tax returns when you file.
yeah. Okay.
Yeah.
Thank you for that. I think we can look at other, packages that are there, or other
Yeah, yeah, other
benefits
vehicles,
that,
yes.
yeah. Yeah.
So no, before we actually move to that, I just want to just make this important for people to understand. The retirement annuity or the retirement savings, those are the investments with the highest return on the market. Okay,
Okay.
the reason why they have their highest return on the market is because you first get return from the money that you're investing, right?
Mm,
And then after that, you also get paid by SARS for saving,
mm,
right? So the fact that you're getting paid by SARS for saving, that beats any investment that you can get on the market, right?
yeah. Yeah.
And then based on how much you're saving, the more you actually get back from SARS. So undoubtedly, so if you put everything together, it has the highest return on the market because of the government incentive that's backing it.
Yeah.
Now that one is the most important investment. Why? Because it has to do with you being of old age, and then now you have to live on what you have saved, which is the
Yeah.
reality for most people. So it is the one that gives the most returns and is the most important one.
Yeah, especially because now people are living longer. Stats SA
Exactly.
does indicate that people live up to 80, 90. We can see,
Exactly.
that most of our parents who have retired have outgrown their monies that they got when they left work.
Yeah.
And,
And and
so it
yeah.
does warrant you having extra, because then you do have to rely on the grant, which is not sufficient.
Yeah, and I've had to tell one of my clients that they have to go and apply for the grant. And it's such a sad situation because then now, they'll ask me, can you do something? And there's nothing I can do, because sometimes
Mm,
some people get the information late. And sometimes
yeah.
some people procrastinate. They're like, I will do it next year. And then next year passes, and then you're just getting older. And then when the
Mm,
time when you realize that, okay, it's now getting late, then you try to do damage control. Sometimes it's too late, you
mm,
see, and
mm,
then you have
mm.
to go on the grounds, and that's a reality that I wouldn't advise anyone to face.
Yeah, I think what the current grant now is what, 2.5, 2.8. I don't think
Yeah.
it's anything above 3.5. So you can imagine how
Mm,
much it costs just to buy bread, milk, essentials. And if
mm.
if all you have as an income is that, let's call it 3.5. I don't know. I have not checked what the latest is, on pension. But imagine if 3.5 is the only amount you have to live on while you still have children or grandchildren in the house. It can be too much,
you
I understand.
you see, Fina, the issue that I have with a lot of people is that a lot of people have hopeful thinking, right? And
Mm,
hopeful thinking is, oh, I'm trying to run this business, okay?
mm,
I'm gonna be rich, right? I'm doing this, and then my child is doing this, and they're gonna be this person, so I'm gonna be fine,
mm,
right?
mm.
And hopeful thinking is very dangerous. It's a good thing because you need to have hope in the future and everything
Yeah,
else. Like,
yeah.
you need to have a positive outlook to life, but at the same time you need to think of what if. All right, what if the
Mm,
business doesn't work out? All right, then what are you gonna do? You know,
mm.
what if your child gets married and then the wife or the husband doesn't like you much? Then they're like, let go of this old person. What are you gonna do? So people need to think about those things. And sometimes people will be like, no, but we're doing this, it will work out, and then at retirement will be fine. But then the
Mhm.
what if is, it's a very, very risky thing. So normally
Yeah,
it's advised that even if you have these great things that you are trying to do in your life,
yeah.
just always have that that
A
that
backup.
that the backup. And it has to be a
Mm,
strong backup because you never really know what's going to happen
mm.
now with the
Yeah.
business that you're doing, or other things that you're trying to do to increase your wealth.
All right. Great. Let's move then to investments, because you
Yeah.
said an RA is an investment, or by itself, but there
Hmm.
are other investments. Maybe you can enlighten us on the type of investments that are there, and how do we then start investing, and what is the advice you would give as a financial advisor on that.
Yes. So there are various other investments. Like, for example, there's the tax-free investment, right?
Mhm.
Now the tax-free investment is a good one if you're gonna invest long term, like long term, right?
Mm-hmm.
because it gives you up to 500,000, and then you're capped every single year up to 30,000. If I'm not mistaken, it should be 30,000. Then you're capped to that every year, right? Now you can invest over a period of time, right, and just let the money accumulate if you want to. Then with that, you can pick the portfolios that you want based on how much return that you're looking into. So the concept is the same regarding just market investing. So the more returns that you want to get, the higher the risks, right? So
Yeah.
for example, if you're looking into getting 12, 13% a year on an investment, you have to buy stocks, equity in companies and
Mm-hmm.
shares and all that. So Liberty, Discovery, Old Mutual, they have investment people that will invest that money for you. So you don't have to do it yourself, right? And these investments
Mm-hmm.
they start at 500 rand a month, right? Now, now if it's a unit trust, for example, now that one you can cash it out anytime you want, and the concept is the same. You pick how much return you want. So if you want stocks, you are gunning for more returns. Then if you want maybe medium return, about 8%, 9%, then you'll be given less risky portfolios.
Mm.
Now that the risk that you take is so the thing is that if you're taking risks with your money, right, they will give you more money as returns if those risks work in your favor, right?
Mm.
But then if they
Mm.
work against you, then you're more likely to get hit harder on the market compared to someone with a more conservative portfolio. You
Mm.
see, so what we tend to advise is, let's say you are someone who just wants to save but you don't know when you might want to cash the money out. So normally we advise that you take a unit trust or these tax-free investments, right? So
Yeah.
that you can just apply and then your money is paid to you sometimes within 30 days, right? So those are more like flexible investments, and then you can save as much as you want from like 500 rand upwards, and
Mm-hmm.
then you can pick the risk that you want to take. Are you gunning for high returns or medium returns, or just returns that are maybe slightly above inflation, and then
Can
from
you
there.
mix? Can you have a mix where you say in the first 6 months I want high returns, and then once you get those and you've secured them, you say, okay, now let's be more conservative.
Yes, you can, but you have to be in contact with the financial advisor, because then I'll be able to do it for you in the system. So you can
Mm.
say, okay, in this year I want to take high risks, and then after that year, can we now switch the portfolios to more conservative portfolios? That, yes, I can do that for you. I'll have obviously to change the portfolios for you in the system, and then and now depending on the type of investment you've taken, sometimes you can incur fees on changing portfolios, right? They're
Mm-hmm.
normally low fees, and if you decide to stick with the same portfolios, then
Yeah.
you just then you can obviously see how those portfolios are performing, and then if you're not happy with the performance, you can always change them as well.
Yeah.
So to answer your question, yes, you can always switch from high risk to medium risk to more conservative portfolios anytime.
Okay, great. I'm sure you saw that question that popped up before we move. Let's just answer. The question is, what's the difference between the RA, the unit trust, and tax-free savings account?
Okay, so the retirement annuity, that one is the one I just mentioned now, where you're saving for your retirement. You can't cash that money out. You can only cash it out at age 55 plus, right? And with that, you're rewarded by SARS by them paying you tax returns for saving through the retirement annuity, right? So retirement is strictly money that you're putting aside for your retirement, because when you retire, you're not going to be earning any more income, right? So you need to be
Mhm.
liquid. You need to be able to pay for your day-to-day expenses. So that's the whole point of the retirement annuity, and that one is directly connected to SARS on the tax returns, right? And that's the only one where you get paid for saving by SARS. Now, the
Yeah.
unit trust is just the investment where you pick portfolios that you wanna invest in, right? Where you can pick the insurance you want, Liberty, Discovery, Old Mutual, and then you just say, okay, I wanna save 500 rand a month, and I might want it at any time you know, and then within 30 days or so, you can always cash the money out whenever you need it. So it's like a savings account that is more that doesn't have in that the way, you know, money is not locked in like the retirement annuity. So the
Mm.
retirement annuity you can only cash from 55 plus. Now the unit
Yeah.
trust you can cash at any time that you want. You can just send a request to your financial advisor, then they can pay you the money. Obviously, it's advised that if you take a unit trust and then you start saving 500 or 1,000 or 2,000 a month, you at least let the money multiply first through the
Mm.
investments before you can just cash it out, right?
Yeah.
And then the tax-free savings, this is also backed by the government, where with the retirement annuity and the unit trust, you will get taxed, right? Now with the tax-free savings, you won't. You see, so it is a good savings vehicle if you want to put money aside where it's not gonna SARS is not gonna put their hands in the money. Now with the unit trust, whatever returns that you earn, you will still need to get
Pay
taxed on
tax.
those. Yeah.
Mm.
Now they're normally taxed within the fund. So when you cash out, they already go and they pay SARS. So Liberty Discovery will go pay SARS, and then they'll pay you
Mm. The balance.
the balance. Yeah, but
Yeah.
it's only taxed on the returns. So it's not taxed on your initial capital. So let's say you have a unit trust and you're saving 1,000 rand a month, and you save 10,000. They're not gonna tax your 10,000. They'll only tax the returns that come from the 10,000. That
Mm.
amount, the profit, is what they will tax, and then
Mm.
they'll give you your 10,000 plus your profit less the tax.
Yeah.
Yeah. So that's those are the differences between the three.
Okay, and I hope we have sufficiently answered. If you still need more clarity, Google, you can write in the chat and we will attend to it. So let's continue with the different investments. Are
Yeah.
these the only three, or are there other ones that we might, want to
So
consider?
so for people who want to invest in the medium term, right? The retirement annuity is considered long term, right? So the medium term is normally 5 years, 5 to 10 years, right?
Mm.
That's normally medium term. Now, if you are someone who wants to, especially for the young people, if you are someone who wants to be buying properties, and you want to be in a place where you are buying things cash and then you don't want to be owing the banks money, I strongly advise that you take the 5 year investments. And those are the ones that I use to purchase everything that I have and that I own, right?
Mm.
So what I tend to do is I open a 5 year investment. I save. I didn't run a calculation, and I say, okay, if I save this amount of money for the next 5 years, how much is it going to be after 5 years? Incorporating
Mm-hmm.
the returns, the expected returns in the portfolio, and then
Mm.
if in 5 years you can actually buy a property. All right, Fina, I don't remember. I showed you the endowment
Yeah.
where I'm putting 7,000 every month, right? And then there's the lump sum for 25, right? So the 7,000 every month for the next 5 years, right? I'll just
Mm.
quickly run the calculation for you here. Um, so if we say 7,000, right, by
Mm-hmm.
12 by 5 years, right, it's
Mm-hmm.
420,000, right? And
It's
then
how much
you
you
for
got cut off there? It's
so let's say you're saving 7,000 a month. This is for
mm-hmm.
people who want to buy properties, right? Because I do
Yeah.
this for people who want to buy properties, like apartments. I normally, this is normally the calculation I give them. So they will
Mm-hmm.
have to save about 7,000 a month for the next 5 years, right?
Mm-hmm.
Which will be 7,000 times 12 times 5, right?
That's fine. Yeah.
Yes, that'll equal 420,000, right?
Mm.
And then if we add a return, based on their age, obviously, if we add a return of, let's say, 12%, or 11 to 12% a year, we'll be looking at
Mhm.
about 53% on top of the 420, right? Then we say times 1.53, we'll get about 642,000,
Mm.
right? That's
So from your
642,000
money, you saved 420, but as an addition, you get plus
additional
minus 200,
600. Yeah.
give
So
and
you'll be saving
take.
about
Yeah.
Yeah, give and take. You put about 600 and something thousand, right?
Okay.
At the end of 5 years.
Okay.
Now,
Yeah.
this is also in the event that you're also putting in some money as well, some add-ons. So when you get your tax returns from SARS, you make a lump sum
Mm.
into that endowment, and then they're
Mm.
called endowments. They're called
Yeah.
endowments. So you put into that endowment, and then you do that for 5 years. Then you can literally go and purchase a property cash, literally.
Yeah.
And all these things is numbers, because someone will ask, how do you purchase a property cash, right? And then
Mm.
you give them the numbers, and then they're just simple numbers, but if you abide by those numbers religiously, you will get to the end goal in 5 years, you
Mm.
see.
Mm.
And then now in 5 years you already own a property, compared to someone who say, let me go to the bank and get a bond. All right.
Mm.
Then you go to the
Mm.
bank and get a bond for that small property. But now the bank is saying 20 years plus
Yeah.
interest on the bank. You see? So
Yeah.
now it's going to take you something that can take you 5 years, is going to take you 20 years. You
Mm.
see? So endowments, I strongly recommend endowments for the young people more specifically, because then they can literally already start building their portfolio. So what's going to
Yeah.
happen when you have a property now, let's say you rent it out, and then now instead of saving 7,000, you're saving 14,000, right? What's going to happen now? You're looking into buying two properties in 5 years. You see,
Mm.
so
Mm.
so the concept behind it is the concept behind the short term to medium term. I strongly believe those are the most powerful vehicles to grow your wealth. The
Yeah.
5 to 10 year endowments, they are extremely effective, right? So for me, I started a new endowment in January, and now we're in June. Whenever we get into these meetings with people who are going to reach out to me, I'll show them my portfolios, right,
Yeah.
so they can see what I'm saying. So now I started one in January. Now we're in July, and I had debit orders on the 7th, and now I'm sitting close to 100,000 from just January to now July, right? So
Yeah.
what tends to happen whenever I get any lump sums or do anything, I just put it in there. So I've got one with Liberty. I've got another one with Discovery. So then
Mm.
I do that consistently, and I'm gonna be doing that consistently for the next 5 years. Then
Yeah.
when 5 years hits, I cash it out, right? And then now the question will be, how are you acquiring all these assets? And then
Yeah.
you explain to people, is
It's not a
just
snake.
it's
It's
not
the
a snake.
savings.
Yeah. There's no black
But if
magic. There's
somebody's saying, hey, 7,000 is too much, that's what I earn. Let's say somebody
mm,
earns 7,000 or
yeah,
even less. Can they
yeah.
still afford to do these savings? Or it's only for
So
the high earning, high end individuals?
yeah, so an endowment with Discovery starts at 850. Okay.
Okay.
And then an endowment with Liberty starts at 500 Rand.
Okay.
Okay. But now the thing with Liberty is you need to put a lump sum up of 25,000, right? And
Mm.
then you can start putting 500 Rand every month. With Discovery, you don't need to put a lump sum. You can just start at 850 Rand a month, right?
Mm.
This is with the endowment. Now, if you can't afford the 850, and then you're not able to do the 500 Rand with Liberty, you can have a unit trust, right? And then unit
Mm.
trust runs for the 5 years, right? So in as much as you're able to cash it out, right? Because remember, endowments, they lock your money in for 5 years. So
Yeah.
they make you're disciplined, because then now you can't just go and cash it out, because then
Mm.
you incur serious penalties for doing that, right? But the unit
Mm.
trust, if you're not earning a lot of money, you can take the unit trust, because the unit trust, you just have to start at 500 Rand. But then now you have to be someone who's disciplined, where you're
Mm.
not going to then say, okay, I'm short on the car payment. I want my money from my unit trust, because then
Mm.
now you're gonna revert back. So you can use the unit trust as a form of an endowment for the 5 years, only contributing 500 Rand a month. And then with that, you don't have to put any lump sums in, and it would be affordable to some degree to a lot of people, right?
Yeah.
Now the thing is, this is the reality that's there on the table. Let's say someone is making 10,000 a month, right? And then
Mm.
they have all these expenses. The thing is, the way the system is designed is, the more money that you have saved, the more money that you make, right?
Mm.
That's why you
Mm.
find that rich people get richer, right?
Yeah.
So the only way to get out of a difficult financial situation is if you say, I'm making 10,000 Rand a month, but I have to start saving something so that at least I have an opportunity to have
Mm.
money that's going to be working for me and I can get out of my situation. Because
Okay.
if you say, I'm not making enough, I'm not even going to be able to save the 500 and I won't, be rest assured, 5 years later, you're going to be in the same position, you see,
Mm.
and then you
Yeah.
never ever get out of your situation. So let's say, let's see, let's look at it this from the numbers perspective. Let's just say someone is making 500 Rand a month, right?
Mm-hmm.
They're saving 500 Rand a month. That's the most they can afford.
Yeah.
And then we multiply that by 12. That's 6,000. Then you multiply that by 5. That's 30,000, right? They would have saved 30,000 in 5 years. And then
Mm.
we add the 1.53. That person's got about 45,900
Mm.
in their account. So they're only saving 500, but in 5 years they have about 50,000. You see?
Mm.
So this is very important. I just want to just clarify this to you. Now, I have sat with extremely wealthy people, and they do not feel sorry for people that don't have any money. Unfortunately, most of them
Mm.
don't, right?
Yeah.
Because what they say is, well, yes, you are making 10,000 Rand a month, but are you even trying to save 500?
Mm.
See, so who do you expect to come and save you? They do not feel sorry for people at all, and then they literally cash out large amounts and they go for golf and they go holidays and they come back. No sympathy,
Mm.
because they say, this is what one person said to me: the people that are making less don't even save at all. They don't even try, and they start
Mm.
at 500 Rand a month.
Mm.
You see,
Yeah.
so to some extent, you look at people. They'll say, okay, I'm making 10,000, but then they're buying a bottle of Hennessy.
True. That we know.
You see,
Yeah.
or they're buying
Whatever they are buying.
whatever they drink, right? They can
Mm.
buy that, but they can't put 500 Rand a month. You see,
Yeah.
so it's like you need to be responsible with your life and to realize that you have to try, regardless of what situation you're in. You start from
Yeah.
there, and then from there you work your way up. So someone who does that for 5 years, then they've got 50,000. So even if they're making 10,000 a month, in 5 years they've got 50,000 more. They're 50,000
Mm.
richer, right?
Yeah.
And then
Yeah.
that 50,000, if they put it in an endowment or whatever, now it's going to start growing at a much faster rate, because now it's 50,000 that's growing, not 500 Rand. You see?
Mm. Mm.
And then
Mm.
in 10 years time, you see, now you're sitting at 100 something thousand. You see? You see what I'm saying? So
Yeah.
that's how it works. And then eventually, maybe in 15 years, you can actually go buy your property, you can buy a house, you can buy something
Yeah.
that you buy land, something that puts you in a better position. You see? But it will never happen if you don't start. It
Yeah,
just
and
won't.
time moves quickly, like you were saying when we started,
Mm,
Um, so maybe let's encourage parents to encourage their children, because a lot of times, we do give, and these days our children are fortunate, they get monthly allowances, it's not only for movies, it's not only for
mm.
hair and nails and whatever. If they start, if your parents are giving you 1,000, take that 500 and open an endowment account for yourself, and you'll have that money at the end of 5 years. You have that
Yeah.
50,000, you have that money. You can
Mm.
even go and negotiate for your parent to augment and deposit your smaller nyana jorki car, So I
Yeah.
think we
Yeah.
need to teach our children to think in that way, so that they move away from this dependence on parents, but they start developing this independence. And if you do it in your youth, by the time you are an adult, it's a habit now. You don't struggle with doing it.
Yeah. And you want to know one thing that I can just clarify to you is, a lot of the times, right? Once you do it for the first 5 years and then you get your returns, it is so rewarding and so addictive that you
Mm,
will want to keep doing it, right? Because now
mm,
you see what you've worked for. You you see what you, because you see what a lot of people, what they say to me is, look, I was working for 10 years or 5 years, this whole year. Normally it's conversations in December. I started working in
Mm,
January. Now it's December. I don't even know why I was working, what I did. I didn't get anything. I can't see why I was
mm,
working. These people are always using it. You see, when you put in, you save, you be like, okay, this is what I earned this year. This is what I've done. And then in 5 years or 10 years, you see, you can be like, wow, okay, this is what I was working for. It's so
yeah,
rewarding. And you find that people that normally cash out their investments, those are the people that actually bother me the most. 'Cause
yeah, yeah,
people who cash out their investments are the people that bother me the most. Now with the children, you find that that culture already that you mentioned now, a lot of people in higher net worths, they already have engraved that in their kids. So what
yeah,
they do is every single time when they cash out, they say, Curtis, take this sum of this money, give it to my child, and get that child to contact you and put money in investment.
yeah,
You see, and then that child actually calls me, can we do this and this? And I put it in for them, and then the money starts to grow. You see?
yeah,
So it is so important that once you get your child to actually, cash out in 5 years, and then they go and they're, oh wow, okay, I've been saving this amount. I actually bought my car, or I bought this, or I bought that. They will then, be more motivated to actually do it themselves. So
yeah,
you're 100% right. The children have to be motivated to do it so that they actually see it firsthand, and it's not something that they're just hearing from
yeah.
me as during a financial planning session.
Sure. We don't have a lot of time left. Somebody, I think, in the comment corrected, and maybe they were asking or they were making a statement. I saw that they were saying Liberty also doesn't want the 25,000. They are saying Liberty starts at 500 and there's no need for the lump sum.
No, no,
So,
no. The yeah. So the 500. We're talking about endowments. So endowments
mm,
require an upfront payment of 500,
okay, okay,
right? But then they do have investments like unit trusts and other tax-free investments where you can start at 500. So
okay.
when I mentioned the 500 was specifically for the endowment. So I
Yeah,
hope
yeah.
that's clear.
All right, great. So
Yeah.
let's look at other policies, and here you can cover disability, dread disease cover, income protection, just so that people know what else exists out there as an option.
Yes. So there's one important benefit that is now on the market. It's a new benefit. They call it the
Mm-hmm,
premium settlement option. Okay. Now this one is strictly with a company called Bradrock. So what that does is when you pay your premiums for your life cover, right? Let's say you got a life cover, you pay your
mm-hmm,
premiums, and then when you reach retirement age, your premiums stop, but then your life cover stays in place and your dread disease stays in place. They call it
mm-hmm,
the premium settlement option. So basically, what you're doing is you're having an agreement with the insurance company. You say, look, I want a life cover, but I don't want to be paying for it when I reach retirement age. So can
mm,
we agree that I pay for it now? Then when I get to retirement, I don't have to pay for it, but then my life cover stays in place for my children to get on the day that when it comes that I pass on,
yeah,
right? Now that has been keeping me very, very busy because a lot of people are running to that. They want that
mm,
because no one wants to pay premiums at retirement age. Now, Liberty,
mm,
Discovery, and
mm,
Old Mutual, they're working towards getting to that premium settlement option. But then
yeah,
it's a bit complicated because obviously they have a lot of clients. There's so many things that they have to look into, nuances on other policies they're already onboarded in, and other ones that are coming in. But that is the future. That
yeah,
is the future. Now, with that one, unfortunately, if you are 15 years close to retirement, right, then and you're not, they won't allow you to say your retirement age is 70. So you need to be at least 55 and below for you to qualify for it. So if you're
mm,
past 55, you won't be able to get the premium settlement option. But that one is so, so good for people that are below 55. Because when you reach retirement, you're not stressing about paying premiums on your life cover, disability, dread disease, right? And
mm,
the dread disease is so important because remember, with the older you get, the more prone you are to getting sick.
Yeah.
So now, when you have this dread disease cover that you're not paying for, if you get a stroke or if you have any like serious illnesses, that those insurance companies will pay for you, right? They'll pay to cover that, and that is so important. I don't know how I can stress it to people that if you don't have a life cover, if you're not just disability dread disease, reach out, contact me, let me assist you. Because if you don't have that, and then especially if you're getting older and then you're past 55, you won't qualify
Mm.
for some of these benefits, right?
Yeah.
And
Yeah.
then and then for the young people who say no, but I don't need the life cover now, I'm still young. See, life cover works well, life cover works like medical aid.
Mm.
So the insurance companies know that there are some young people that don't want to pay any premiums, but they want to jump on the ship later on. So
Mm.
when you do decide to then contact your financial advisor and say, now I want life cover because now I've got kids, I've got this and this and this, what's going to happen is they're going to incorporate your age into the calculation of the premium. Then they
Mm.
will make you pay for the years when you were not paying for your life
Yeah.
cover. You see, because you're taking it later on. So someone of your age who started it 5 years before you is going to pay less compared to you who's starting it 5 years after. You see,
Yeah.
because then you're jumping on the ship later on. You see,
Yeah.
so
So
now
it's
the
a catch-up
premiums
fee.
is a catch-up fee. Yeah, yeah. So I think the thing that beats a lot of the thing that is so that's the benefit that's outstanding now on the market is this premium settlement option, right?
Okay.
And
Yeah.
that one is undoubtedly one of the best benefits that I've seen so far in my 8 years doing this.
Yeah.
And what I've been doing is I have clients from Liberty that would say, okay, I want the premium settlement option, and then they would say, um, so they'll say that I want the premium settlement option, and the premium
Mm.
settlement option, I will have to then reduce some of the life cover from Liberty so that I can
Yeah.
put some of that life cover with Bright Rock too, so they can just capitalize on that premium settlement option.
Yeah. Miriam
Yeah.
seems to be an advisor. Miriam, maybe you can also enlighten us in the chat with some of the information. She's saying there's an investment builder or education builder, which allows for 500 recurring premium. And she categorizes as endowment policies as well that do not require upfront payment.
So the investment builder and the okay, so it depends which company she's talking about here. Okay,
Yeah.
because remember she might be talking about Sunlam and other companies, but with
Mhm.
the investment builder with Liberty, you cannot get an investment builder without the lump sum, a minimum of 25,000, right?
Okay.
So the investment builder it's I have one, actually, my own personal one that
Yeah.
I have with Liberty, and they always require that 25,000 lump sum payment.
Yeah.
Now, the educational policy, you can just pay 500 rand a month, but that one is obviously you're saving for education and all that. You can do that at 500 rand a month, but the investment
Mm.
builder, absolutely not.
Okay.
The especially with Liberty, that's not actually how it is. You can save 500 rand a month, but you will require an lump sum payment for minimum of 25,000.
Okay.
Yeah,
And so, Miriam, we do appreciate if you can share more information from what you know, and then people can go and inquire for themselves. I guess at the end
absolutely.
of the
Yeah,
day, if you feel that that's where you want to go, you can call Liberty, you can call
mm,
whichever company, and then inquire
yeah,
the information from the horse's mouth, right?
yeah.
So maybe before we close, because I know there's more that we can talk about, just take us through again, for people to understand the disability cover. When do you get it? How does it work? Dread disease cover. Can you have both? Should you have only one? And
So so the
add it to
so
your
so
life cover or separate. You can have these two without a life cover, just so that people know
yeah.
to help with decision making.
Yeah, so disability cover normally is crucial when you are still employed, right? So
Mm.
after you've reached retirement, it should fall off, because at that stage you need rare disease cover and you need your life cover, right? Now,
Mm-hmm.
there's what they call occupational disability, where if you get disabled in the workplace, then they'll cover you for that disability. So depending on how much disability cover you have, they'll pay it as a lump sum to you, or they can pay it to you as a
Mm-hmm.
monthly income, right? Now disability
Mm.
cover is mandatory and is very important when you're working, without a doubt. All right. Now, dread
Yeah,
disease cover, because you can get disabled. I mean, you can get in a car accident, anything can happen. So you need to think about those things, especially when you have children and you have debts and you have, people that are looking up to you. You cannot just live your life and then you're not covered for disability. That is not
mm.
that's not good at all, right? Now, this dread disease cover, I mean, there are cancers. You can get a heart disease. Anything can happen, right? You can get
Mm.
tumors, brain tumors, anything. So you don't want to be in a situation where you get that, and then your medical aid pays, and then there's that gap. Then what's going to
Mm.
happen now? How are you going to close that gap? Then now you're
Mm.
calling me to close your endowments. You're borrowing money from people. Now you need charity. You don't want to find yourself in that position. So sometimes it's just
Yeah.
good to just have that dread disease cover. And even if it's 100,000, 250,000, just so that you're not in a position where, if you get diagnosed by dread disease, you don't have money to cover the gap that's left with
Shortfall.
the
Yeah.
medical aid. Yeah, because
Yeah.
medical aid will pay, but they're not obligated to pay everything. Depending on the medical aid you have, what cover it is, there will always be
Mm.
that gap, right?
Okay.
Yeah, and then life cover is mandatory for anyone who has children, right? And then anyone who wants to apply for loans, like a bond, and
Mm.
or if you have significant debts. So that one is mandatory. Now, if you don't have children and then you don't have any dependents, let me just put it as dependents, not children. So
Yeah.
if you don't have any dependents, and then you also don't do any debts,
Oops.
or you don't have any loans or bond, then you don't necessarily need life cover, right? So it's not true that everybody has to have a life cover. It has
Yeah.
to be tailored to who you are as a person. But most people need life cover because most people are going to have children, and a lot of people acquire debts and they also want to apply for bonds from the bank and the like.
Yeah. So
Yeah.
bottom line is we don't only have to have funeral cover because almost everyone has that. We know how to plan for our deaths, our
Yeah.
funerals, and everybody else's
and
funeral because we cover other people in those. But these other important ones that we spoke about today, not many people know
yeah,
about
and
them or have them.
And you know the interesting thing about the funeral cover is when you have a life cover, for example, Liberty, right? If you pass on within 48 hours, they pay for that. So it's like you're already getting a free funeral cover coming in. They call it
Mm.
an immediate expense benefit. So whilst so sometimes a lot of the times if you have a life cover with Liberty, you might not even need to have a funeral cover because within 48 hours, the immediate expense benefit kicks in and they pay you
Yeah.
up to 50,000, right? They pay you out to 50,000, and then that 50,000 you can cover your funeral things and everything else whilst they're investigating the cause of death and everything before they pay the
Yeah.
life cover. So sometimes with life cover alone, you already have a funeral cover within it because of that immediate expense that it pays within the 48 hours.
Yeah. And maybe
Yeah.
many people don't know that because
They don't know
people who sell
that.
funeral covers are pushing for
Then,
you to have,
yeah. And
that
they won't tell
beautiful
you.
funeral.
Yeah, and they can't tell you because if they tell you that, then you're gonna be like, well, let me just get the life cover then. So why am I then getting the funeral cover, right? So
Exactly.
the funeral cover is
Exactly.
good. Now let's say you're covering like older people, and sometimes you can't have your family members that don't want to get a life cover, right? And then you can't go and impose a life cover on some people. So, but then you
Mm,
also
mm.
know that if they die, you are the one who's gonna pay for their funeral expenses and everything. So then in that case, that's where like funeral covers really work because then now you can be like, uncle, you know, be on my funeral cover. because I know if anything happens, I'm gonna have to cover that, and I don't want to do it.
Yeah.
Normally, that is the best case to be getting funeral covers.
Yeah.
Yeah,
I think we've run out of time, but thank you so
yeah,
much. We are better enlightened in terms
mm,
of what is out there and the urgency with which we need to start saving. Because if we have
mm.
not started now, it's too late. Tomorrow it's too late for us to say, I'll do it tomorrow. You need to do it now as we talk. So any last maybe input you want to give just to encourage somebody who's still not sure, but they are thinking about it? What is your encouragement as a financial advisor as we close
So,
today's
so what I
session?
so what I encourage everybody is my contact details are there. Call me, right? Sit down with me and just listen. You need to be someone who's open-minded. Listen and get the information. You don't necessarily have to take what information you've been given, just like this session, but at
Mm,
least be open-minded to hearing what's out there and what you can do to better your life, right?
yeah.
And then from there you then sit down and make decisions, because sometimes people don't make the right choices because they just don't have the knowledge. So I strongly
Mm,
advise that if you're someone who's serious about having your financial affairs in order, be open-minded. Just I know, so you can think how money works. And a lot of people say, because I buy things, I budget my money every
yeah.
month, I know how money works. It's fine, but just be open-minded to hearing what else is out there. And even at my
Sure.
age, even with 8 years in this, I still sit down with other people and hear what are people investing in,
Mm,
what else is there globally, what's happening in England, what's happening in America, what are they selling there, what products they have, because that's so important that you remain open-minded, and then you make sure that you get the information, because sometimes if you don't, you will pay the price for it, especially with things related to retirement and things related to life covers and everything. They're so critical. So you have to be willing to sit down with a financial advisor and just listen and get the information.
Thank you. We're gonna leave it there. Thank you very much for availing
Yeah.
yourself. And people,
All right.
please do take those details down. Give Curtis a call, send him an email. He will gladly respond to all the questions you have. So we have no excuses to make right now in terms of not
Mm.
saving. It starts as little as 500. Now I'm making an ad. I sound like a marketer. Let's pray. Father, thank you for such a great session. Thank you for the wisdom shared. And again, we ask that may we be people who use information that we are given to empower ourselves and to live better lives. We thank you. We honor you. All glory back to you, Father, in Jesus' name. Amen. Thank you, Curtis.
Thank you very
And
much for having me.
all the best with all your endeavors and all those properties that you are acquiring.
100%. Thank you. And I'm gonna
Sure.
make sure that we catch up
Ladies and
again another
gentlemen,
time.
here
Okay.
Sharp.
is the most listened to radio show on the planet. Even the other stations are tuned in too.